All right, here we are. So from the beginning, it turns out that, we've done these. Wow, when was our first one of these?
5 months ago plus.
Wow. So March-ish, we did the first one of these. We've done these pretty routinely. We did it weekly for about a month and a half, 2 months, and then we've done it every other week since then. And we've had 1 or 2 or 3 people on most of the calls recently. And, but what we're seeing is a lot of people are going back and looking at the recording. So we do record this and we put it up on both YouTube and eventually it gets up on our website. We do have a new website. I want to make sure everyone knows that. The new website is mindful.money. Yes, very exciting. I'm very happy about that. It's been a long time coming. So the way this works is, if you are here, when you do come in, this is for you, Frank. If you have a question, just pop it into chat. We're happy to answer questions specifically as we go through some things. This is actually, you might, in the invites, this says Q&A. So it's actually designed for us to answer your questions. And we have, however, done like a 5 or 10 minute presentation first so that people kind of know what we're thinking about. And we're reporting on some of the indicators, like we're reporting on some high frequency indicators, some of the other bigger things that maybe a concern for folks. But by and large, we do a brief presentation, we answer questions. So anything that comes up, by all means. If something comes up after this, email us. I know there's going to be a lot of questions. I think the next 6 months are going to be special. We're going to have a lot of volatility. We're going to have a lot of talk. As per usual, most of the talk is going to be noise that we can ignore, but there's going to be some things that we should probably pay attention to. So we're going to be bringing up some of those things here. And so before I launch into the higher frequency and some of the important indicators, I wanted to see if anyone else here, on the team had anything they wanted to add before we start digging into stuff.
The first one was March 20th.
Okay, since March 20th, and that was in March, I think 12th, and maybe it was that Friday where we did a big one. And then we did a video before that and a bunch of writing and stuff. So we've been doing this pretty consistently for a long time. Anyone else have something to say before?
I just want to thank Frank for bringing to our attention what he said earlier about he's learned that the economy is not the market and the market is not the economy. There's not a day that goes by. It happened this morning where someone's not saying to me or Paul, when we're on these calls together, the market's being irrational, the economy's in shambles, what gives? And so I hope we touch on some of that stuff today, but I think Frank, you're spot on. And we'll get into some of that later, but really good comment you made in the beginning of the call.
Yeah, good. Unfortunately, we didn't capture it when we recorded, Frank. So it sounds like Scott's the one that came up with this. All good. Okay, so let's talk about some of these high frequency indicators. Now, again, I have a list of these things that I go down almost every time we do this. And the big question we have is how many of them are positive, how many of them are negative? And for the last couple times, 2 weeks ago and then 2 weeks before that, there have been 1 or 2 negative. All the others have been positive. Here, I'm just going to go down the list really quick. It's initial jobless claims, it's continuing jobless claims, it's an ASA staffing index, retail sales, box office receipts, rail car traffic, steel production, hotel occupancy, the average daily rate to stay at a hotel, open table seating, TSA checkpoints, and then gasoline supply, as well as the final one was Apple mobility data. So your phone has a chip and they know everyone that's moving and where they're moving to and from. So the more mobility suggests more economic activity. And so all of these things are measurable and they're looked at month over month, week over week. And so we have this continuous flow of information. And 2 weeks ago, I think it was steel production was down and maybe the average rate of hotel was down. Those two are both positive now. And they're both positive month over month and week over week. And actually, yeah, I'm looking at it month over month right now. And average daily rate of hotel occupancy is down 1% month over month. It's up about 0.8% week over week. So higher than it was last week, lower than it was last month. This just expresses some sort of sense of volatility, or it could express the choices of hotels people are going to, more expensive, less expensive. There are only 2 negative week over week numbers this time around out of all that data. One of them is initial jobless claims. We did see an increase of about, I think, 200,000, maybe 150,000 over last week's initial jobless claims.
Went up to 1.2 million, right?
But yeah, it went up to 1.2 million from 1 million. So it's still, we're gonna get a little deeper into the employment numbers in just a second. And then the second one is the supply of gasoline is down. So there's a lot of people driving, so the supply of gasoline is down. There's a lot of productive capacity that's not being utilized right now because there is still a lot of supply. Gas supply is still very, very high right now. So of all of that data, of all of those individual high frequency indicators, the two that are down week over week are initial jobless claims and supply of US gasoline motor oil. And every other one of those, continuing jobless claims continues to decline. Retail sales continues to be better. Rail traffic continues to be better. Hotel occupancy continues to be better. Open table continues to be better. The number of people going to movie theaters continues to be better. And so this is all an indicator of things slowly getting better. We've said this from the very beginning, we cannot expect this to be a straight line. It's going to be fits and starts. We're going to have setbacks in many of these individual things. We're looking at the big picture. We're noticing that sometimes on a week over week basis, 1 or 2 or 3 of these is going to be negative, but then they're going to return back to a positive number the next week. And then month over month, we're hoping to see some pretty steady increases as well. This last week, there were some larger numbers that came out. There was the National Multifamily Housing Council. They report on rental late payments and non-payments of rent. So if you go back to August of 2019, 92.1% of people renting paid, based on this statistic, 92.1% of people renting paid their rent in August of 2019. So that means what? 7.9% of people were late or failed to pay rent in that August a year ago. Today, that number is 90%. So in a normal year, and in fact, we could argue that 2019 was a pretty good year, you see about 7.9%. Right now it's up about 2.1%, which means that 10% of people aren't paying their rents. That's a little bit lower than it was in July. So that's something that is decreasing. The number's getting worse right now relative to a month ago. It's still not that bad relative to what it was a year ago. And this is just renters. There's another category of people that are reported by either the Black Knight Index or the Mortgage Bankers Association. And so the Mortgage Bankers Association reports that 4.2 million homeowners are in some kind of a forbearance program, meaning they've reported to their bank, they can't make their payments, they're not in default or delinquency because they've made an arrangement with their bank to manage that and maybe tack a couple payments onto the back end. So their bank has said, we believe that you'll be able to recover from this and you'll be able to make these payments later, and their bank has given them forbearance. The 30-day delinquencies are up about 1/3%. And that's not good, but they're up to 2.34%. So the current 30-day delinquency rate is 2.34%. 60-day, it's up about 1.3% to 2.15%. So it's still very, very low. It's up a lot from what it was last month. And this is the highest 60-day delinquency rate since 1979. Still very low, has an effect on the overall economy when people aren't paying their mortgage payments. And some of these people may be, in discussions with their mortgage companies and trying to get to some form of forbearance. And some of them may ultimately have to sell their homes. Some of the people we may see foreclosures. That comes down the path. According to Black Knight, the new delinquencies have fallen below what they were pre-COVID. That's a good sign. And so these are numbers that are important to realize that while we see a lot of headlines about how bad things get, they're maybe not as bad as those headlines suggest. John, I wanted to put this to you because you brought up some numbers this morning from an AARP article. I wanted to see if you had those handy and you could actually report on some of that stuff as well.
Well, I do have it handy, but there's another little piece in here. If you're worried, that the U.S. economy will never recover. It goes on to say that during the 1918 influenza epidemic, left almost no discernible mark on the aggregate U.S. economy. Of course, we're in a different day and age now, but still, the co-authors from the Northwestern University's Kellogg School of Management, the co-authors point out that global pandemic doesn't inevitably lead to a grave economic recession or depression. If your gut tells you that things are only going to get worse, know that your gut is a terrible economic forecaster. While the University of Michigan's decades-old index of consumer sentiment hit rock bottom during the Great Recession, that measure of consumer confidence was at its lowest point in 28 years, but only 4 months later, the economy began its longest expansion in modern US history.
Yep, that's awesome.
What I was talking about earlier during our team meeting was, if you're worried that so many big companies are going out of business, you have to know that only 63% of companies that started trading publicly between 2000 and 2009 survived for 5 years. So there's just a lot of attrition. And they also point out that the number of publicly traded companies in the US fell from 7,500 in 1997 to 4,000 by early 2020, even while unemployment was down and the economy was growing. Of course, we talked about a lot of that, was .com, and then what happened after that in 08. But still, it's those are the numbers.
So I want to. Those are fantastic. I'm going to share my screen. I'm going to pull up a couple things here that come out of Yahoo Finance. So I want to talk about what bankruptcy means, because there have been, this year, a lot of bankruptcies, and this is retail, and we got the same thing in restaurants, and there's going to be a lot of these, and we're going to see a lot more of these. But what does that mean? When a company runs into financial difficulty, one of the things they can do is that they declare bankruptcy. And what that does is it holds back the people demanding payment so that they can reorganize stuff, and so they can start paying these things back in a different manner, in a manner that allows the company to keep operating. Sometimes in a bankruptcy, the stock price will go to zero. The people that lend the company money end up owning the company. They get equity for their bond shares. And we saw this in 2008. We saw this in 2000. We see this every time there's a major economic disruption. So the reality is, when you look at any of these restaurant chains, when a restaurant chain goes bankrupt, all of the equipment that they have still exists and is still useful equipment. There's still people that know how to run the equipment. And so somebody else, that company can be reorganized and go back in and open up again in a month with a lower debt level, which is why when the US government bails out banks, it's because they're the ones that lose in that scenario so often. A lot of times it's the shareholders of the company will lose. Those are the first people that lose if you own stock. But then there's this reorganization, and some of these companies can go back and start working again. So the fact that they've declared bankruptcy is just, okay, we've got to reorganize some of our debt and some of our payments so that we can survive this whole thing. And that's true whether it's a corporate bankruptcy. It's also true whether it's if it's individual bankruptcy. And the thing that's yeah, Scott, you want to say something?
So is this showing us that on the left is Chapter 11 protection? Wait, go back up one. Yeah, is on the left Chapter 11 protection and on the right Chapter 7? Is that what's going on here?
So no. So look at the little filled in dot and the little clear dot. So some of the ones on the right are Chapter 7, and some of the ones on the left.
Oh, I see.
Right? So there's a little dot down the middle.
Got it.
There's only one there that's Chapter 7. That's supplantation. The rest of them are all Chapter 11.
And maybe speaking to one being a reorganization, like you're describing, and one being a full-on liquidation would be helpful.
I think 11 is the reorganization, and the 7 is the full-on. We're done. We're closing our doors, right?
Yeah, 11 is definitely reorg.
Yeah. But even in, it's really important, even in the case of the Chapter 7 where they close their doors and they're done, other restaurants or other individuals who are thinking about opening restaurants then buy their used equipment at a lower price and they can launch a business cheaper. They don't have to buy new equipment. There's all this,
Right.
you know, there's all these people grab this stuff and then resell it. There's these, I don't remember what they're called. I remember back in 2000, when we bought our office furniture in 2000, I was moving the office out of my house. Okay. This is like 2002, 2003. And I looked at these people that were selling furniture from crash.coms, crash law firms that supported .coms.
Yeah.
And get a really good price on office furniture. Like if you went direct to one of these, you know, I think it was MG West at the time, you could get Cole furniture or all this kind of great furniture for really expensive. Knoll, Knoll. It's like $6,000 for a desk. Same desk, slightly used in a law firm, $1,000, right? So there's a huge upside. Sorry, it's not an upside. There's potential for future use of these things at a lower price. So the question is the impasse on a next round of congressional stimulus spending have an effect on the market in a meaningful manner, positive or negative? Not really. I don't think it's going to affect the market. I think it's going to, so the people that, let me split this,
headlines, but
yeah, let me split this into two things, right? The first thing is the actual impact long-term on company earnings. And then the second thing is the shorter term headline risk that Scott just mentioned. And there's a whole big argument about, hey, we need to have it now. That argument has now been going on for 3 weeks, the we got to have it now argument. And the markets have gone up over those 3 weeks. And the reality is there are people that will rely on this. And so we have to figure it out and do something. And the thing that, you know, Trump did, the $300 that hasn't gotten anybody, that one, not helpful. We do need to have a better program that's broadly applicable, that's broadly accessible by people in the United States that have lost their jobs and whose companies aren't hiring back right now. Or people whose companies are hiring back and they don't feel safe going to work. There needs to be some kind of protection for this. But when those people get that money, the place they are going to shop they're going to buy food. They're going to pay the whole rent thing that we have here and the home payments. It's going to be spent in places that right now are actually not hurting. So if they're going to buy food with it, Safeway isn't hurting right now. Safeway is actually doing a lot of business. They may provide a little bit more boost to Amazon, but Amazon doesn't need a boost. Amazon is doing really, really well right now. They're not going to do things like, buy new cars. And that's where things are hurting a little bit more, as those kind of companies are selling high-priced yet not quite necessity-type goods. What do they call those? Consumer durables. Those aren't necessary purchases right now, and so it doesn't really affect the market that much, positive or negative, unless it's a headline risk kind of a thing. And the thing is, in the next 4 months, there's going to be a lot of headline risk because it'll be this issue, then it'll be another issue and another issue and another issue. I'm curious, folks on the call.
Well, there are some places, if they don't reach agreement and there's no support for continued support for people who've been laid off, eventually that's going to hit retail sales.
Sure.
But more importantly, if they don't come together and provide support to states and localities, there are going to be layoffs at the state levels, which could be quite significant because they're under the necessities to balance budgets. So I think that in the longer term could have an impact on the market, not in the short term.
So as that's happening, let's look at expectations for Q3 GDP. So this is a known thing, right? We know that states and cities are going to have a hard go, and while states and cities are going to have a hard go, there's an expectation that GDP is going to go up. Merrill Lynch says 17%. the New York Fed says 15%, the Atlanta Fed says 25%. So while there's going to be some places where you see more layoffs and more pain, there's going to be other places that are actually advancing and doing better. The Bureau of Labor Statistics, I just read this the other day, Bureau of Labor Statistics says that unemployment is down in 30 states, hitting records in 3 states, Connecticut, New Mexico, New York. So there's going to be pockets of difficulty and pockets of greatness. The greatness is not the right word, recovery. And then there's going to be this gray area in the middle, and it's going to be the net effect that matters. I think that, again, I don't know. I don't know. I can't predict. There was a study of 150 biggest cities and the effect on their budgets of the revenue changes relative to sales tax and these kind of things. And it's on the order of $180 billion, somewhere between 180 and like $220 billion as in aggregate for the 150 biggest cities in the country. That's a lot of lost revenue, but it's actually less than the federal program that's already in place to support cities and states, right? So that money is there and accessible. Cities and states aren't tapping it for some reason. I don't know if it's because they don't have, maybe there's too many hooks on it. I don't know what the reasons are why they're not using it. Maybe it's because they don't need it yet. And then 3 years from now, you'll see some spillover from property tax revenues to cities and states, but that doesn't happen right away because they already determined that a year ago. Anyway, so there's just a lot of stuff going on. I think what we have to remember is that we're looking at a net change, and there will be lots of pockets of pain, and hopefully the pockets of good overcome the pockets of pain. Does that make sense? And I sort of believe that they will. It's kind of usually what happens in these scenarios. Scott, you want to say something? Did I put you on the spot?
I just think there's really, I can just keep hearing the same exact thing, and I think it's really important. One of the things that's coming up on a regular basis is the idea that these companies that I grew up with, that I see, they're very in our face, whether it's all the airlines, American, United, Delta, or all these department stores, Macy's, all the ones that are in trouble right now. And I think it's just so important to recognize that some of those particular industries and what do they actually mean to the pie of the S&P. And I think that's just so important to understand. And so those department stores amount to 1% of that pie. And that's why, there's obviously unemployment related to the losses of jobs and things like that. But as far as the index return from the S&P, those department stores don't have an impact. And so although it looks like there's napalm out there and it's really scary, that slice of the pie it's a sliver at best as far as department stores go. I think another really good example are the lodging, the travel, the casinos, the cruising, the oil, all those spaces. Travel in particular, I think is 1.8%. So there's about 50 of these industries within these sectors, but there's 50 industries that are in really bad shape. They amount to 6% of the pie. So it's not said to be abrasive. They just don't really matter as much as they once did to the S&P. The S&P is not irrational. It means that there's about 90-something% of the S&P and these various other industries actually doing quite well. And it's not just technology. It's technology. It's healthcare. It's cable companies. Companies that have very predictable earnings and revenue streams, like subscriptions, like a cable company. Right, that cable bill comes, it gets paid, and so those companies are doing very, very well. And it's not just technology; it's companies like Walmart, Target just hit all-time new highs last week. Costco's thriving, so it's not just technology. I think people need to realize there's a lot of sectors and stuff that are thriving. There's certainly some real damage out there, but that pie and the slice of which they take up these days, it's not what it once was. So that's why the market's not quite nearly as irrational as I think people really believe.
And you've heard us talk about this idea that we're not trying to pick the company in a sector that's going to do the best. Mm-hmm. We're owning all the companies because what we're investing in is people's desire to purchase goods and services. Because whether I'm buying from Target or Walmart or Amazon or my local store, I'm buying, right? And all that money goes somewhere, when I'm going to spend, or what you're going to spend, or what anyone spends, we sort of have this amount that we can spend. In the last number of months, we actually haven't spent that much. Like, I haven't traveled, I haven't purchased any clothes, there's lots of stuff that I haven't done. And when I'm eventually able to do it, I don't think I'm alone in this, I will then do it. Like, I will be able to travel more. I will buy a new pair of jeans. I will buy a new pair of shoes eventually. And that's true of everybody. So there's this, in addition to the fact that people are still selling stuff and people are still buying stuff, there's also this pent up demand that's coming in the future at some point when there's a vaccine. I have one more thing I want to present here. And it's something we talked a little bit about a couple weeks ago. I'm going to share my screen again. And I got this from Sentiment Traders, one of the blogs that I follow. And we talked about the speculation that's occurring, that there's a bunch of people that are buying. And I want you to look at this blue line. The blue line is the S&P 500. The gold line, I think that's gold, is daily online brokerage trades. So what we see here is we see that people got locked down, and you might have seen this in the media where hundreds of thousands of new accounts were opened at, what are they? Robinhood, TD Ameritrade, Schwab, just hundreds of thousands of new accounts have been opened, and they're all trading accounts. And we're seeing the trading activity literally off the charts. This is crazy. These are people that are day trading things like Tesla and Facebook and the FANG stocks. Yeah. And one of the reasons you see so much explosion in these areas is because it's the greater fool theory. And I do think eventually these people and those areas, they get hurt. This is why we don't focus on this as part of our investment strategy, because you have this great upside. There's usually something bad after that, and it's unpredictable when it happens or how it happens. And John has some comments on this.
Yeah, I wonder what's the margin out there. How many people are trading on margin? What are the balances?
Good question.
Because if you look at this, that's a little scary. That's .com-ish right there.
So, to John's point, very scary. And there was a data point that came out maybe a week or two ago. I'm pretty sure it was in August. Robinhood had more daily trades that happened on their platform than Schwab and TD Ameritrade combined. And yet Robinhood didn't exist 5-10 years ago. And so it speaks to the individual consumer out there that's on their own. And I've never used Robinhood before. What I heard was they're in the crosshairs of the SEC because they're making it have this interface like it's a game. So everything you do, there's like these little things that happen, and it's making you feel a certain way, like you're playing a video game. But unfortunately, it's real life. And so the SEC is very concerned about this for good reason, I believe.
Do you see what I just put in here?
Mm-hmm.
Yeah.
This is the S&P, same chart, versus margin debt.
Interesting.
It is very interesting.
Yeah.
You see how it, we see this bottom bunch of people started trading on margin. That's,
yeah.
Does that support the stock market? Absolutely. Now, hopefully all those people that are trading on margin are also putting in, what's it called? They're protecting themselves with
stop losses.
Stop losses. Thank you. Hedging strategies. If you're gonna buy this kind of stuff in this fashion, you better have stop losses.
It's not a real long-term
No.
outcome of success, that kind of thing.
No, definitely not. Definitely not. I'm gonna stop sharing.
It feels like 1999. Some of these charts around the behavior of the average retail investor feels like 1999 to me.
I think it's sort of, but it's squished into fewer companies.
Yeah.
And those companies are huge, enormous.
And profitable. So it's
incredibly profitable.
But the behavior of the investor feels the same.
Yep.
Yeah,
I agree.
behavior.
Absolutely. I think that covers everything I have. Frank, do you have any questions you want us to answer in addition to one we just did?
Well, I'll say it out loud since it's faster than typing. So this one is just odd to the group. Now that we're within shouting distance of the election, you speak frequently of the fact that the market is forward-looking, and so it's looking, beyond the pandemic, even in much of its, and where the profitability of companies are going to be in the future, right? What about is the election? Would you consider the market, whether you're talking about S&P 500 or any other index, election agnostic? Meaning, are they really just looking purely, or in your opinion, are they looking purely at potential profitability of various companies in terms of pent-up demand, like you mentioned before, and where they may be sitting, post-pandemic? Or is there any type of spin or any pricing maybe being put into the mix based on how people feel the election will turn out?
Great. I think that is going to be the question we discuss more than any other question for the next few months. So there's a couple pieces that we need to peel out of this. The first piece is both parties will claim that their policies are going to be better for markets, and they always do. And neither of them gets to make that claim and have any data really to back it up. The markets are, I think you said you used the word, they're sort of disconnected from politics. And the reason markets are largely disconnected from politics is because, there's definitely CEOs that have opinions, and whoever's elected, every executive group has to start making decisions for their company to create better outcomes for that company. The job is to have good outcomes for the company. And so if Biden's elected and we have a higher tax rate, the companies have to figure that out. And if Trump is elected and tariffs stay in place, we got to figure that out. And they got to continue trying to figure that out. There's good and bad that comes with everybody. Anyone that's elected Trump, for all of his talk about how good he is for the economy, he has screwed us with his tariff conversations with China. He's separated us from the global community, which is very bad for the economy. Yeah, he gave someone some tax breaks to sort of cover up the stupidity, but he did those two things. So let's say Biden goes, hey, we're going to raise these taxes back up part way, not all the way, part way, but we're going to actually rejoin the global community. That's going to be a positive and a negative. He's going to mix it up in different ways, and companies are going to have to figure it out. They're going to have to figure out their supply chains always. They're going to figure out how they're going to get over some of these tax consequences always. But we're going to be part of a global community. So it's, there's good and bad. Whoever's elected, there's a disconnect. There's a disconnect. Really what matters long-term is profitability and companies' ability to make decisions to enhance their profitability. Scott, you have something to add?
Yeah, I think it's a really good time to maybe open the screen and share this this graphic, because this question comes up a lot. Can you guys see this? So, and Frank, hopefully you can see it as well. This is going back to 1926.
Can you move it up a little bit?
Yeah.
It kind of gets cut off here. How's that?
I got it. Thanks.
Yes.
But basically, and we were talking to a client about this on Friday, and he said, took the words right out of our mouth. But, I've been hearing this my whole career. When Democrats in office, this is what happens. When Republicans in office, the market does this. And I just love how this chart speaks to that. And with a couple of maybe exceptions here and there, and it's hard to find those exceptions over long periods of time, which is what we are for our clients, long-term investors, the market doesn't really care. There could be a year or so where there's some movement, but I think this speaks, Frank, you tell me, what do you see here going back almost a century, right? The market's pretty clearly ignores over the long term who's in office. And to what Jonathan was saying earlier, I think it's really about, how does corporate America here and abroad, how do they navigate changes in tax, changes in legislation, but over long periods of time, the very best of the best corporate entities and enterprises, they figure it out.
Thanks, Scott.
Yeah.
Does that answer the question, Frank?
Yes, it looks like a general upward trend. I guess right now, in this point in time, you know, two plus months out from the election, then you're kind of saying people aren't really, the market's not really gaming this to predict Biden or Trump is winning. I mean, in other words, they're not skewing things one way or the other. You're not seeing that.
Well, it's a great way to pose the question, because the market is really just a million different participants. And so every participant is voting their shares. You know, they're buying this, selling that every single day. And all of that data of buying and selling gets factored into what we call the market and the market price. And so there isn't really a way to game it. It's just what happens based on every single individual making their choices. Does that make sense?
Yeah. So another way of putting it is an individual company may be making decisions because they predict they will have higher tax consequences, say, for example, under a Biden administration. So that
Absolutely.
may be being factored into their share price in some manner. But we need to think collectively that, you know, each company is making their own decisions. Collectively, that's the market. We invest in the entire market. So therefore, it's just an aggregate of a million individual decisions.
And some of those companies will get that decision right. And some will bet that, hey, it's going to be Biden. Some will bet that's going to be Trump. Some will sort of not make the bet, sort of hedge both sides of it. And you know, some will be right, some will be wrong. That'll reflect in their stock price relative to the decisions that they make. But it'll kind of all come out in the wash, because really the thing that matters that we talked about earlier is, are we gonna? It's earnings, but it's really what are we gonna do? Like, we're 70% of our economy is consumption, is our consumption, and that's consumption of healthcare, automobiles, solar panels, stuff we buy, travels we take, coaching. We consume stuff, and that we buy from different places, and we're going to vote. We're going to vote sometimes based on, I like this company better. I like what their CEO says in public, so I'm going to buy their product instead of this other company and what that company says in public. And that's a lot of times that's what happens. So, yeah, I think you totally nailed it, Frank. It's really our collective that matters, not what any individual decides, because that individual is right or wrong, and they'll know afterwards whether they're right or wrong, but it will hardly matter in the big picture.
So one more question, since I have the microphone.
Sure.
Since we've been talking primarily about the U.S. Stock market, what are you seeing relative to the global market, both in terms of Europe and emerging markets? And are you seeing them in an upward trend right now, relative to the U.S. or relative to each other?
That is a great question, and I think this is something we're going to talk about some more in a couple of weeks when we do this. But just as a quick answer, the thing that's been happening for the last decade, and it's been happening much more tightly in the last sort of 8 months leading up to COVID, is the U.S. dollar has been driven upwards. And so when we talk about the performance of a company, the companies in the emerging markets and the companies in Europe have been doing really well, as well as most of the companies in the United States. But as the dollar has continued upwards, that's hurt the value of those companies doing well for us, because we translate their earnings into dollars, and that hurts them. Okay, so the thing that's happened in the last short period of time is the dollar has taken a dive relative to those currencies, and it has a long-term downward pressure on it, that it has basically bucked that tide for the last 10 years. And maybe we're seeing that reverse right now. I'm not trying to predict long-term, but when we talk about what we're investing in, we're investing in companies, and those companies, all the companies we're investing in have increased their earnings and have done what you want a company to do. But then when you factor in the currency differences, it actually affects the benefit to those people that own the companies. because it reflects back in our currency. At the same time, European companies and emerging market companies generally pay a higher dividend. That's going to be more important going forward. Again, this is something that's going to come up probably in the next session we do this on. But look at what's the company, Jeremy Grantham's company, GMO. So GMO does this thing where they talk about 7-year expected returns. The only thing that has a positive expected return over the next 7 years, according to Jeremy Grantham, who's a very value-based investor, is emerging markets.
The most pessimistic.
He's not the most pessimistic, but he's very value-based, and so emerging markets for him has a positive expected outcome, more positive than anywhere else. That's largely currency. It's also largely the companies have always done well, and there's a lot more growth potential there. There's all kinds of pieces that fit into this. Currency is one of them. Tariffs is another one. Think about this. Let's pretend for a second that Trump pisses China off so much that they say, you know what? We're just gonna allow our domestic companies to sell stuff internally. Guess what? That's the largest market on earth that we no longer have access to as American companies. So you're gonna be a lot better off having Chinese companies at that point. There's a bunch of data problems there. I get that, but our access to global markets is really, really, really important. And you'll see a lot of benefit for those places and their companies to sell domestically if we're locked out. And that's, if Trump is reelected, that's actually a big risk for us. It's because we keep alienating all of our potential trading partners, and we do it like purposefully. So this is, in a nutshell, this is to say we are completely dedicated to international diversification, and we do think that there is value there. I think there's more value there than there is in terms of buying units of earnings for a price, reasonable prices. We get a better deal there than we do here, and that's continuing. And hopefully if that trend reverses, we're going to see a lot of upside because we're already there in the international markets. And I think we've got a few minutes left, but does that answer your question, Frank? I want to make sure.
Yes, thank you.
Okay. So let's make a note that let's talk next time. Let's talk a little bit more about international. Let's talk a little bit more about the currency thing. We'll get a chart to talk about the currency thing as well, and then we'll make sure that that's clear with some data points next time as well. I think that's what we have. John, do you have any other comments? David, Scott?
I was hoping to hear I like the every couple of week update from John about real estate, since he's married to a successful realtor in the East Bay, and any updates there. I always am curious.
And because you're looking, right?
That too.
It's busy. It's very busy out there, and people are buying. Inventory has increased. If you're looking to sell, whether it be because you're moving out of the area or downsizing, it's still an excellent time to put your house on the market, and things are going. I don't have the latest stats, but things are going over asking. The prices, the price that you start the property off at now is higher than last year, and it's going over percentage-wise than what it did last year. So
people are listing at higher prices, and the percentage of overpayment relative to those prices is higher.
Right.
Wow.
Exactly.
John, I recently got an appraisal because I'm refinancing, and my appraisal came in slightly lower than it did a couple of years ago.
Huh.
And you know what? An appraisal has nothing to do with the market.
Interesting.
Nothing to do with the market.
Right,
Yeah, I want my house to be appraised low for taxes, but
right.
when I sell it, I want it to go high.
That's a good point.
But yeah, so appraisals, yeah.
Yeah, I think, thanks, John. That's awesome. I think to Jonathan's point, it'd be good to touch more about currency, what happened to the, I mean, there was a point where the euro and the dollar were pretty darn close to par. And now it's like almost 120 again to the dollar. So it'd be good to talk about currency, the value of the dollar, global, international, emerging. I mean, we haven't really spoken and gotten in great detail there. And we've got a nice presence for clients for good reason. And maybe talking about why be a great idea. I like that.
Good. We'll do that next time. Thanks, Frank. Great idea.
Sure. Catherine's with me. She had a quick question.
Okay. Hey, Catherine.
You got a minute.
Hi. This is a very sort of personal question, but John helped me set up an account for my family's house that's in trust, our summer house in Inverness out at Point Reyes. And it's generating money, which is great. It costs a minimum of $5,000 a year to maintain, to pay for taxes and insurance. And I'm wondering, should I pull that out and put that aside just so I don't worry for the next year, or should I just trust the market and let it ride?
Great question. So this actually goes to some portfolio design stuff. So there's, in every portfolio we have, there is cash, there's fixed income, and there's equities. So if 9 months from now somebody needs access to $5 or $10 or $15 or $20,000, there's money there that can be taken regardless of what markets do. Like we have things that are ballasts to the volatility of the stock market, and we have those things in every portfolio that we manage. So that's partially because, you know, we're used to working with people that, you know, we'll get calls on a Tuesday, regardless of what markets do, and they'll say, hey, I need 10 grand for XYZ, right? So that we know that that's something that happens, so we're ready for it. That being said, you know, if you're more comfortable with $5,000 extra dollars on the side, take $5,000 and let's put it on the side. There's no reason to not do that. That's a fine thing. John, did you get that?
Yeah, I got it. But if it were me, I wouldn't do it.
Yeah.
Because when, you know, back in March 20th, when we had our first one of these and people needed money, you spoke exactly to that.
Yeah.
We've got ballast in there. We've got cash on hand in there. And so we didn't do a rebalance. We didn't touch the equities. We took from the ballast, we took from the cash. And, you know, the market recovered, and the rest is history. And you know, 5,000 is 5,000, but, you know, it's not a lot of money. It really isn't. If you're looking to do a major remodel, you know, you need 50 grand, 100 grand. That's another story.
Yeah, that's good.
You
That's a
guys
good
will
way to
be
put it.
pleased to know that my sister and I redid the floors and the appliances in one room and cut everything down and did it for about $4,000. So cheap
Well done.
labor. It looks
Yeah.
like cheap labor. But
Do it yourself.
No, they actually are super women in terms of remodeling. I was very impressed.
I have a deck that needs some work.
They paint.
thank you guys. Yeah, maybe I wasn't listening on March 22nd, or maybe I didn't go. Who knows? Who knows? But thank you. I'll just leave it there.
Okay. Super. All right. Thanks, everybody. We're going to get this recorded and up probably in, I don't know, 4 or 5 days, so that we can share it with everybody else. And you guys will get it'll be on the head of one of our emails that goes out, and you'll be able to link us if you want to go back and revisit any of this. Otherwise, we'll see everyone in a couple weeks. Thank you.